All right, let's go ahead and take a look. So the very first set of questions is, so questions 1 through 3. It's pretty straightforward what you've seen before. I will be asking you a few questions. I believe there's 5 questions that's going to ask you and test you on your accounts again. So once again, this is chapters 2 and 3, right? Knowing the account type, knowing the category, and knowing whether it has a normal balance of a debit or a credit. So once again, let's practice here. Here's 15 things I've added on here. So I've added newer materials in here so you guys are kind of aware what happens. Okay. So let's go ahead and do the first one. First one is checking. Okay. What kind of account type would checking have?
Asset.
Yes, it is an asset. Okay. Now, what kind of asset does a checking account hold?
Current.
Yes, it is definitely current because it's readily available in its liquid form, okay, which is cash. Okay, so would it normally have a debit balance or a credit balance? Debit balance. Okay. Now, what about accounts payable?
Liability.
Yes, absolutely, it is a liability. Now, what kind of liability does accounts payable hold? Current, good. And what kind of account balance would a liability have?
Credit.
Credit, good. Okay. What about inventory? Right? Inventory was part of chapters 5, 6, 7, and 8. What kind of?
Asset.
Yes. Okay. Now what kind of asset would it be?
Current.
Current, right? We may purchase our inventory items, but the one notion that we have is we can easily turn it around and sell it, all right, for cash. So it is definitely current. Now, what kind of account balance would it have?
Debit.
Yes, debit. Okay. Now, the next one is going to be supplies expense. Exactly, right? Keyword here is you have the keyword right there, expense. So it's going to be definitely an expense account. Now, what kind of expense would it have?
Operating.
This is definitely an operating, right? We only learn 2 major ones, right? Because we don't learn about non-operating because that's more advanced level of accounting. But we learn that there's cost of goods sold and we know that there's operating. So anything that's not a cost of goods sold is going to be operating. Good. And what kind of balance would it have?
Debit.
Debit. Good. All right. What about accumulated depreciation?
Liability.
A liability. No.
Oh man. So close. You made it sound. You sold it.
Okay. What do we use accumulated depreciation account for?
Expense.
Okay, we do use it for an expense, but in this type of way, what is the accumulated depreciation actually used for? It's not an expense account. Okay, why would you make it an asset?
Stuff that depreciates.
Okay.
The PPE.
PP&E, good, excellent, good. So if we're using to depreciate fixed assets, therefore, yes, it is definitely an asset. No, what kind of asset? We talked about PP&E, so therefore that makes it what?
Fixed.
Fixed. Now, in terms, okay, if you're looking at accumulated depreciation, what kind of normal balance would a accumulated depreciation account have?
I mean, debit.
Not a debit account. Okay, you don't ever increase in accumulated depreciation.
Going to be credit.
It's going to be credit, right? There's only two options, right? Debit or credit. If it's not debit, it's going to be credit. Now, why is it a credit account?
Because we're losing money.
Yeah, you're depreciating the asset, so you're taking away from it.
Good. What do we call those types of accounts? Starts with a C. It's a contra account. It flows in the opposite direction of the actual main account. In this case, it's depreciating the fixed asset, right? It's losing it's a placeholder, or it's representing the loss of a value of the actual fixed asset. So you're not increasing it, right? You're decreasing it. So in this case, it is a credit account. Okay. What about bad debt expense?
Liability.
No, it's not a liability.
I think what's that?
Would it be income?
It's not an income account. Let's look at the word very carefully. Bad debt expense.
Expenses.
It's an expense. Good. Now, what kind of expense would this be?
Without looking it up, I'm going to say current.
Okay, is there such thing as a current expense?
Okay, no, okay.
Operating expense?
Operating, correct. Okay, so now the question is, why isn't it a cost of goods sold? Well, let's take a look at that. When do you actually use bad debt expense? What did we learn in chapter 10? Why do we use bad debt expense?
To write off bad debt.
Exactly, right? To write off money that we can never collect. So in that case, is money that we collect anywhere directly correlated to inventory? No, it's completely separate, right? Cost of goods sold is directly correlated to inventory. So in this case, that already gives you an indicator that it's not cost of goods sold. So therefore, the only option that you have is operating, right? So when we actually decide to write off, right, we're going to expense it, right? The terminology of expense, right, is to get rid of, to spend, to use. Those are going to be your determining factors of expense. In this case, we're writing off bad debt because it doesn't exist in our books anymore. So we need to spend it or expense it. Okay. So therefore, if that is going to be an expense, an operating expense, what kind of credit or debit balance does this account have?
Credit?
Okay, no, sorry, I didn't give you the answer, but no, it's not credit.
It's debit.
It's debit because it's an
Oh, you would
expense.
increase, yeah, to increase.
Yeah.
Okay.
And the opposing would be my allowance for doubtful accounts. Okay, so there you go. It is not a credit. Oops, no, I don't want to get rid of that. Okay, good. What about inventory? Oh man, I have inventory here twice. My bad.
What did you say the opposite to the bad debt expense would be?
The credit? The allowance.
Yeah.
The allowance for
Yeah.
doubtful accounts.
Oh, yeah, okay, that's what I thought you said.
Okay, I have inventory here twice, so I'm just gonna blur this one out just because you can't really. I mean, if you want to answer it right, what is inventory? It's a current asset, yeah.
there another term we should put there?
Term? No. I didn't guess I didn't view this carefully. I added another account when it wasn't supposed to. Well, I think I was moving accounts back and forth, so. Okay. All right, what about unearned revenue?
Ability?
It's a liability. Excellent, right? What kind of liability is an unearned revenue? Current. Good. And what kind of balance would it have?
Credit.
Credit. Okay. Now we have accounts receivable. What about accounts receivable? What kind of account?
Asset.
Mm-hmm. No, what kind of asset?
Current.
Current. Good. And would it give me a debit or a credit balance?
Debit.
Right. Accounts receivable is another sense of IOUs that your customer pays you. So in this case, they owe you money. Okay. What about furniture?
An asset.
Yes, it's an asset. Now, what kind of asset?
It's a fixed.
Fixed, right? Also known as PP&E. So what kind of balance would it have?
Debit.
Debit.
Yes, debit. Okay. What about owner's withdrawal?
OE.
Okay, which is owner's equity. Good.
And then none for
Excellent.
Has no category.
No category. Now, what kind of balance would an owner's withdrawal?
Credit.
that's what I thought. It's a debit.
Oh,
It's a debit because
It's a
this
debit.
one,
yeah.
it's going to decrease your equity account. So in this case, if you learn that with the accounting model, equity is increased with a credit. In this case, it's decreasing it. So in that case, it has to be a debit balance. Okay. Next is sales. What kind of an account is sales?
Income.
Income.
Income. Good. Income / revenues, whatever you want to associate it with. Okay, I believe in the test I use revenues. Right? Now, what kind of income?
Sales.
Sales. Good, right? Sales. Now, what kind of normal balance would a sales account have?
Credit.
Credit. Right? What about cost of goods sold?
Expense.
Yes, it's definitely an expense. Good. Now, what kind of expense?
Cost of goods.
Yes, COGS for short. Okay. Now, with the cost of goods sold, what kind of balance would that have?
Debit.
Debit. Okay. And then let me see, we got two more. What about depreciation expense?
Expense.
Mm-hmm. What kind of expense?
Long term.
Is there long-term expenses?
No, I'm just looking at the category on two. I mean the catalogs.
Operating expense.
It is operating. Good, right? We only learned that there's there are three overall categories for expenses, but we don't learn one of them, right? So you're only left with cost of goods sold or operating. So in this case, it's kind of like pick and choose. You only have two to choose from: cost of goods sold or operating. Okay? And what kind of balance would this typically have? A debit, yes. Last but not least, the allowance for doubtful accounts. What kind of account is this one?
Would it be expense as well?
In this case, no, not for the allowance for doubtful accounts.
Liability?
It is not a liability because the allowance for doubtful accounts, right? You're basically assuming that the people who owe you money can no longer pay, right? So in this case, it's not what you owe them, it's what customers owe you.
Liability?
No. For liabilities, you owe someone else.
Income?
It is not income.
Is it going to be expense? Just
No, it's not expense.
That would leave
asset?
assets.
Yes, because what is the allowance for doubtful accounts? What is that? What? Okay, I'll just give you the term. What is that a contra to?
That's it. Accounts receivable.
Accounts receivable. Excellent. So therefore, it is directly because it reduces the accounts receivable, right? It's our placeholder account. It reduces our accounts receivable, right? So therefore, it's our contra account, which is a current asset, right? If accounts receivable is a current asset, therefore the allowance for doubtful accounts is also a current asset. However, what kind of normal balance would an allowance for doubtful accounts hold?
Would it be credit since the accounts receivable is debit?
Correct. It's a contra account. So therefore, it should always have some kind of credit balance. Okay? Excellent. Okay? Good job, everybody. So once again, these are kind of, things that we've learned throughout the chapter, right? Depreciation expense, allowance for doubtful accounts, right? We learned what a fixed asset is, right? We had to make purchase of our fixed assets before we can have an allowance for, before we can have an accumulated depreciation. Okay? All right. So now we are moving on to chapter 4. Okay? That's pretty much what I'm going to be testing you on. Once again, I told you that there's 5 questions I'm going to ask you that are going to be revolving on random accounts, and your job is to tell me what is the account type, what is the category, and what kind of normal balance. It's identical to the first exam, right? I'm going to give you a box. The only difference is you should be knowing by now what each one does, okay? So there's no need for a description, right? I've explained it multiple times because if I asked you depreciation expense, do I need to explain what depreciation expense is? Right? No. You should know that from chapter 11. Okay? So here, so again, I will ask you 5 questions. So that's already 5 questions that you could possibly get right or wrong. Right? Now, question number for chapter 4. Okay, let's take a look. Under the rules of GAAP, okay, which rule states that when you establish a business, you need to keep your personal and your business transactions separate?
C.
C, business or economic entity. Yes, that's the exact definition. Okay, I may ask you a definition question. I may ask you an applied question. So if I asked you, if you open up a business and you have a personal credit card and a business credit card, what is that a perfect example of? Right? And you would say the business or economic entity because the rule states that you must keep your personal and your business transactions separate. So by doing that, you need to apply for 2 credit cards. Or at least have 2 credit cards, one for personal and one for business. Okay, excellent. So I will be asking you a couple GAAP questions. The next one, okay? If I purchase a machine for $500, okay? And in my books, I must record it as $500, okay? And even if I plan to sell it for $700, which GAAP rules states this?
C.
C?
C, historical cost. Yes. So once again, the day that I sell it, I must record it at historical value until I get rid of the asset. Okay? And whether you sell it for 500, 600, 700, whatever it is, you still got to record it in your books that it's $500. Okay? Number 6, okay? Customer A decides to purchase, okay, an item for $15.65 from your store on an account. Okay? A few days later, you received a payment for $15.65. You must properly record the sale and payment. Okay? So for which gap rule governs this?
The monetary states?
Monetary. So in this
No.
case, okay.
Full disclosure?
What is there I need to disclose about this particular transaction?
The sale and the payment.
Okay, so what
Okay,
extra information?
Okay.
Yes.
No, well then, would we go under matching principle then?
Yes, it because historical cost, right? I'm not telling you that I purchased these assets for or whatever the items I purchased it at a lower cost. In this case, I recognized that I made a sale for $15.65. However, that means the person that pays me must pay me $15.65, no more, no less. And I need to record it. So in this case, we're matching my sales to my payment. So B is the correct answer, okay? Out of all the answers, right? Revenue recognition would be second best. Because in this case, I am recognizing that I did occur a revenue, right? That I made a sale, right? I made a sale for $15.65. But out of the answers, do I have revenue recognition as one of my answers?
No.
No. So now you got to do process of elimination. Okay? So monetary unit. I have already disclosed this, right? If it's asking that I need to measure my price point in terms of dollars, that would be an example of monetary unit, right? So make sure that you guys go through the definitions because once again, these are the underlying things that you need to know, especially when you're doing accounting. You need to know these principles, ins and outs. Okay, so in this case, this is a perfect example of matching my sales to my payments I received. Okay. Number 7, okay, cash basis is when?
It's recognized when cash is received.
Good. What else?
Expenses are paid when cash is available to spend.
Good. So therefore,
B and C.
T.
B and C, this is cash basis. Okay, so cash basis recorded when it has incurred, which is not correct, and when sales has been earned, no. So what did you say? So who said B and C?
I did.
Okay, so no.
Oh.
That's the accrual basis.
Yeah, it just would be A, wouldn't it?
It would just be A only. Good. Okay. Oh, wrong one. There. Okay, so now it says which of the following is not a step in the accounting cycle?
D.
D. Making decisions based on your financial statements. Of course, that's not a step on there, right? Your only step to do is just to produce it. You don't need to make any suggestions, decisions, anything, right? That's going to be subject to whoever's involved, such as your profit managers, your marketing managers, your sales manager. I just said that. But anyways, yes. So no, you do not make decisions on making your financial statements. You just produce it. That's it. So, yes, closing the books is definitely one of the steps, and we'll take a look at that in the fictitious business. Okay, let's see if we're good on time. All right, chapter 5 now. Okay, question number 9. Okay, what are the tracking methods used for inventory? A, periodic and perpetual. Okay, pretty straightforward stuff. You need to know this. Okay. Question 10. What are the costing methods used in inventory?
D.
D, all of the above. Yes, remember, when you're using periodic, you have FIFO, LIFO, and weighted average. When you're using perpetual, you have LIFO, FIFO, and moving average. And of course, we can never forget about specific ID. In this case, I just don't teach it. There's too much other stuff going on that you should know over specific ID. Okay, so all the above. Oh, come on, all the above. All the above is the correct answer. Okay. Number 11. Okay, what? Oh, so when delivery charges are made on COD, what does that mean?
C.
Cash on delivery.
Cash on delivery, right? Not currently orders discharged, not code on demand, okay? And definitely not crate on departure. You know, those are pretty close, but that's not the correct one, and it is cash on delivery. Okay? Good. Number 12, okay? What is the definition of periodic and perpetual?
A.
A, right? Periodic means once in a while perpetual means constantly. Yes, that is true. Okay. All right, number 13. Okay, true or false? Okay, at the end of a periodic, at the end of the period under the periodic tracking method, a conversion entry is needed.
True.
True.
Yes, right? Because when we remember, right, from periodic inventory, right, we recognize our inventory as expenses first. And then at the end of the given period, we need to convert it to show that we actually have inventory. So yes, you need to have a conversion entry. Okay. So here for the rest of the questions, we're going to go ahead and do the examples here. So here, I have an example. A couple things that you need to know about this example is what? That this is going to be, the tracking and costing method is going to be periodic, and it is LIFO. Okay? So let's go ahead and go through the example. So what happened on June 1st?
We bought 100 toys at $1, and freight was $25.
So then what's my purchase price?
$100.
My total cost?
125.
Oh. And therefore, what's my cost per unit? Cost per item?
125.
$1.25. Good. Now here it says here on June 10, you decided to purchase another 200 toys. Okay. So what do we do here? Oh, I put. Oh, no, 200 toys at how much per?
125.
125 with the freight costing you 50. So therefore, what's my purchase price here?
$250.
Plus 50.
200.
All right. right there for what is 150. Good. All right. Now we have on June 12th. What happened on June 12th?
Sold 200.
Okay. So where do we put that?
We don't.
We don't. Why?
It's just inventory. Our purchase.
Okay, good, right? We're looking at periodic inventory. We don't care about anything that we sell because at the end of the period, right? That's where someone has to go take a physical count and let us know how much we have. So our assumption is whatever we don't have is what we sold. So in this case, we don't need to care for the transaction on June 12th. So then what happened next?
You purchased 300 toys at $1.50.
With a freight of 75. Okay, so therefore, what is my purchase price here?
450.
And my total cost?
525.
And what is my cost per item?
175.
175.
Okay. So then, what has happened next on June 20th?
Sold 250.
We don't care for that. So then, what happened on June 30th?
750 on
So here, I already have it already there. So what's my total here?
600.
600 items. Total purchase price?
800.
800.
My freight.
150.
And lastly, what's my total cost?
950.
Okay.
So no.
Yep, that's correct.
Oh yeah.
950. Okay, so then if I have 150 left, how many did I sell?
800.
If I have 150 left,
450.
450, yes, because my total is 600.
Oh.
Okay, so there you go. So now I need to figure out one or the other, whether I solve for my ending inventory or do I solve for my cost of goods sold. So how I've been teaching you is go ahead and calculate your cost of goods sold. So if my inventory method is LIFO, then which batch am I going to take out from first?
The last one.
The last one, so 300, right? Is 300 enough to cover all 450 items? Okay, I see what you say. Okay, good. So if 300, so am I going to take all the batch or some of it?
All of it.
All of it. So here I already know 300 times my $1.75 is going to result in $525. Okay. Now I sold 300 items. How many more do I need to sell to get to 450?
150.
Okay. And at what cost per item is my second batch?
150.
Which should give you
$300.
is it $300?
Hold up. 225.
Yes, 225. Okay, so therefore, in grand total, if you sold a total of 450 items, okay, at what total cost?
750.
750. So therefore, what should be my ending inventory?
$200.
Good. Okay, so let's go ahead and answer the questions here. Okay, what is the total cost of the ending inventory?
200 again?
You could do 950 minus the 750. the total cost of 950 minus 750 should give you 200. Okay. Or you could do it this way, right? You could take your 100, so we know that's 125, right? And if we take the 50 remaining here, that should give you 75. So what's 125 plus 75? 200. Yes. So either way, you could either solve forwards or backwards, or just simply, if you know what your cost of goods sold is, you should be able to determine your ending balance by comparing it to your total cost. Okay. So here, question says, what is the total cost of your ending inventory?
200.
B.
B.
200. Okay. And then what is your total cost of the cost of goods sold?
C.
750. Okay. Oops. Okay, good. All right. Now let's go ahead and do this again, but this time I need to make sure that you know that your tracking and your costing method is once again periodic, and this time it is FIFO. Okay. So let's go ahead and go through the scenario once again. Now notice this. No, they're the same. Okay, so let's go ahead and go through each one. So once again, what happened on June 1st?
About 100 toys at $1 a piece. Freight was 25. So expense, total purchase expense is $100. Total cost is 125, which comes out to $1.25 per unit per item.
Good. Okay. And all right, let's go see what happened next. What happened next on June 10th?
Purchased 200 toys at $1.25,
Mm-hmm.
and freight is 50.
So purchase price should be $250. Making your total cost $300. Making. Mm-hmm. So yes, this is identical to the one above. So I'm just gonna go through it since we have time. So then we could skip July 12th or June 12th and jump right to June 15th. So what happened on June 15th?
You bought the 300 toys for the 150 each, freight 75.
Okay. So there you go. And last but not least, we have 150 items. But this time, what is our costing method? So it's FIFO. So here we should have 600 items at $800 plus 150 of the freight, giving you a total of $950. Okay. So once again, if I have 150 items left, how many items did I sell? 450. Okay. So this time, because we're using FIFO, which batch am I going to be taking out from first?
First one.
First one, which was the 100 times $1.25, which gives you 125. Okay. So that's our first 100. What's the next one that we're going to take out from?
The second batch.
Are we going to take all of it or some of it?
All of it.
All of it. So we know for a fact that the 200, if we're going to take all of it, is going to cost me a total of 300. Okay. And then last but not least, we only have one more batch left. How much am I going to be taking out from this last batch?
150.
150 times $1.75, which should give me a grand total of
262 and 75 cents. Remember? Do my math again. and 50 cents. Sorry.
Good. All right, so total those all up, and what is your total cost here if you have a total of 450 items? What's your total here?
687 and 50 cents.
68750. Okay, 687.5. So therefore, what should be your ending inventory?
262 and 50 cents.
262.50, right? You take that away from the 950, you should get the 262.50. Okay? All right, so let's answer the questions. Okay? What is the total cost of your ending inventory?
C.
C. Good. All right. Oh, hit the wrong one once again. And last but not least, what is the total cost of your cost of goods sold?
D.
C.
C or D?
C. C.
C.
My fault. Yeah.
Very good. Okay. Another one. All right. All right. So right now, I'm gonna take a break now. Sorry, I'm getting a little tired here. So let's take a quick 20-minute break, and we'll go ahead and resume the rest of the study guide till we get to chapter. What chapter did I say to get to? Chapter 8.
8.
Perfect. Okay, yeah, that should be perfect timing. Yeah, let's go take a break real quick. I need to get